get started with some charts I put together. This is actually a chart, the only one of the few charts in this presentation that is not in a letter, but I thought was relevant for today's presentation as well. And I'm going to go over what we call the rise of hard assets and what some of the big cases of why we think this is the time to be deploying capital into this segment of the market. And then there's many reasons. It's a capital flows dynamic that we think it's going to flow back into these assets. It's a valuation perspective as well, but it's also the fact that we think that central banks are trapped globally, and also governments have been irresponsibly spending capital in a way that we haven't seen before, and that ultimately is what creates a long-term inflationary era. This chart to me is one of those sort of dilemma parts of the macro discussions of how we continue to sell down, or I should say sell, allowing your treasury holdings to be reduced by letting them mature, which is what the Fed it has been doing. The Federal Reserve used to own a very large amount of U.S. Treasuries, and it still does, but it has been allowing those treasuries to mature rather than repurchasing those. And therefore, we're seeing the yellow line fall in a significant way. The blue bars is basically showing you how much we've been paying in interest payments of the federal debt relative to GDP, which we've seen higher in the past. However, every minute that we see interest rates is staying where they are, we're going to see this blue bars increasing drastically over time. So what gives in this chart is basically the idea. At what point do we see the white line or the line starting to rise? Because the blue bars are already at levels that become an issue for the government. Today, we're running basically almost 4% of GDP is being used to pay down debt, just to give you a sense of how significant this is. Back in the 1940s, just to also give some historical perspective, we had a problem as well with the debt imbalance being as large as what it is currently. And that was the buildup era of prior to the World War II, or during the World War II as well. And then the rebuild process that we had after that. How do we get out of there? Well, they had to run a primary budget that was a surplus, meaning if you exclude the blue bars in this chart and you see how much the government's spending, it was actually getting a surplus on it. In other words, it was collecting more taxes than what was spending in capital. In other words, it was actually being more financially prudent at that time. And so can we see a world where we go from a fiscal dominance environment into a surplus environment? It's going to be very difficult. I don't know. We can go through the reshoring, the green revolution, and all sorts of other policies without creating this fiscal dominance environment. So this is a dilemma. This is what essentially creates an environment where the yellow line is likely to rise, just because the Fed is the institution that is responsible for purchasing U.S. Treasuries and being the buyer of last resort of U.S. Treasuries over time. Let's go to the next chart. So the letter is going to go through a lot of things, but one of the main aspects is this trend that I found across many central banks and economies across the globe. And I used 4 examples in this case: the U.S., Canada, Australia, and the ECB, or the European Union. There are a lot more. It's just I thought those are more pronounced and easier to understand what my thought was. But basically, we're seeing central banks across the globe really trying to implement quantitative tightening because of the inflationary trends we've seen globally. And this is, at the same time, most of their money supply indices have been on the rise and then completely diverging from their policies. And so while we're seeing what's supposed to be one of the tightest monetary policies in developed economies history, still we're seeing monetary base and also the credit in the system create also money supply to be rising significantly. And this is, to me, another reason why It's another way to sort of, it's a relief valve in the financial system, and further monetary dilution essentially alleviates this financial stress that we're seeing. It's, we hear from the banks, regional banks have a problem, the government creates a facility towards it. Recently, we've had Freddie Mac. Kevin was talking about Rio State. What I find interesting is that, what we have to be working under the assumption that rules will be changed, just like they did in '08, which '08 was to me, was a big change in the macro environment, where we've had some of those mortgage-backed securities and also some of those agreements that were made back in those days that was illegal at the time to be changed, and the government was able to change. Back in 2020, when we had the junk bonds illiquidity event, if you recall, when the COVID recession was at its worst levels and caused a total lack of liquidity that completely dried out across most of the corporate bonds, guess what the Federal Reserve did? They created a facility to buy those instruments. Now, we did the same with recently in 2023, in March, when we had the SVB and the other banks, regional banks. Guess what they did? They created another facility to take care of that. So this is why the white line continues to rise, is because almost no issues are allowed to happen. We're in this environment where it's almost like a banana republic. I can't believe that we're all seeing this happen, and we still need to make a case and write a letter about why do we invest in hard assets. To me, that's just a sign of the times, to be quite honest. Let's go to the next slide. And so here's an interesting idea, and I probably use red and yellow for a reason, because we're looking at the Big Mac index. It basically looks at across different countries of how much it costs to buy a Big Mac in different parts of the world in US dollars. And so this is and then what I realized is when I was looking at this and I was looking at different countries, is that I realized there was a lot of developed economies that had a higher cost for a Big Mac than the less developed ones. And look, I am from Brazil. I go to Brazil every year, sometimes multiple times of the year. And what I realized is that for the first time in my, at least in my lifetime, I'm seeing the cost of living in the U.S. being more expensive than living in Brazil. And not only from a dollar perspective, you may say, well, that's because of the currency. Not really. I've been in Brazil many times, and I've never seen the cost of buying clothing, the cost of rent, the cost of going out to eat. All these little things that add up to your cost of living in a developed market are certainly in a level that I've never seen before in the U.S. And while you can see Europe being actually one of the largest ones, Switzerland certainly should be there, but Europe also at one of the largest ones, as you can see. I would say that the U.S. is even more pronounced than what I've seen so far. Canada certainly is in that camp of things are extremely expensive, and cost of living is certainly have gone up significantly relative to other places in the world. And I'm not here to say that the cost of living for Brazil and other emerging markets are really cheap, but I'm here to say that this is a very important aspect. This changes. And if you go back in history and you think, okay, when was the last time we've seen a Big Mac cost more in Brazil or any other place in South Asia or South America relative to a developed market? Well, that was in the early 2000s. And this has to do with the commodity markets. There's a lot of things that are involved with this, the cost of a Big Mac or the cost of inflation overall. And the main reason for this, it has to do with the fact that when you have a commodity markets that is very favorable and you see the currency of emerging markets doing better, you tend to see also a more controllable environment of inflation. And that's why you see those emerging markets doing better when it comes to being capable of dealing with inflation in a much better fashion than developed markets. What worries me today is the fact that the governments in most developed markets are actually not facing this inflation problem with the same degree that they should be. in the same way in terms of being serious with the problems that we have than most emerging markets, and therefore why we're seeing some of those currency or FX movements that we're seeing recently with Brazilian markets and Mexican peso actually doing better than most developed economies. And so those are all important things happening globally, and this Big Mac index is just a way of actually expressing that opinion. Let's go to the next chart. And so you can see in this chart, there's a Chinese gold rush that I called in this title of this chart, which basically really is just China accumulating gold in exchange for U.S. Treasuries, as you can see here. And this is an important aspect, as you can see. A lot of economies are being forced to improve the quality of their international reserves, as we tend to see historically. When most of those institutions and the federal, or I should say central banks overall, start to really accumulate gold, this is the time when we tend to see other more traditional institutions that allocate capital to follow along ultimately. And the same way we saw back in the 80s and the late 70s when actually central banks have started to buy treasuries, we're probably going to be see the same aspect today. And so I'm paying close attention to this chart. This is not to say, if we go to the next chart, I believe this is not to say that China is or I'm making the case for us to be investing in China, or it makes China a more investable place than other areas. By no means, I think that's really the case here. China, to me, is going through what I think it's going to be a process of Japanification here, where we're probably going to go through a stagnation of their economy for a long time. Now, when I show this chart, the first thing a lot of people said to me, is this in nominal terms or real terms? Tavi, don't you understand that U.S. is going through an inflationary period and China is not going through an inflationary period? Well, let me maybe show one chart that I recently used. Well, next one. As you can see here, money supply in China is double the size of the U.S. So that is not really a justification here to say that China is going through that stagnation process because there is no inflation in China. No, there's massive monetary dilution happening in China as well, and more than the U.S. In fact, the Chinese economy is about 40% smaller than the U.S., but their M2 or money supply is about double the size of the US. And so how do you explain that? This is what I think is when an economy enters a phase where they're having to generate more or create more debt to generate less units of GDP. And that's what Japan went through. And what was the lesson that we had from Japan? The lesson was monetary dilution caused the Japanese yen to fall apart. And so what do we think it's going to happen here? Probably going to be the same going with China. And in my opinion, this is not the end of China or anything along those lines, but it just reinforces the view of owning gold. If anything, the monetary and the macro imbalances China is facing, just like Japan did and continues to deal with, I believe that only reinforces the case to own gold and other hard assets. Let's go to the next chart. And so you can see here an interesting technical chart, but also even you can make a more of a macro case here as well, looking at commodity prices relative to U.S. Treasuries. Well, Treasuries return something in terms of yield, and commodities are only returning something in terms of the price. As you can see, it tends to actually underperform Treasuries throughout history, but it's quite remarkable that we tend to see some periods where commodities outperform Treasuries, and those tend to be during periods when we have inflation. And more importantly, these issues with hard assets, which we tend to see hard assets outperform financial assets, particularly at times when financial assets are extremely overvalued. I find it interesting how much gold, for instance, went up back in the 1970s when the U.S. government had much less debt than what it does today. And at that period, it allowed the U.S. government to let interest rates rise as much as they did back in the 70s. Now, if gold had such an incredible decade, not only gold, but silver, copper, agricultural commodities, energy, had such an incredible period of performance in the 1970s, despite the fact that interest rates were rising as much as they did, what would have happened today where we do have some level of limitation of cost of capital rising, given the fact that we have such a large imbalance. Can we see prices of gold going to unprecedented levels? My opinion is yes. I do think that what the environment is creating and what we call the trifecta of macro imbalances and all these issues that we're seeing are likely to create also set the stage for gold to reach levels that we've never seen in the past. And so this is the mentality, at least I take, and I think the Cresca team takes, and I can speak for them as well here, in order to deploy capital into mining companies, is because for us, the economics of those projects will be drastically different at prices that we that we really haven't seen in the past, and until cost really catches up to that, and given the fact that it's required to increase the supply of metals in an environment that we're living in because of the demand that we're seeing from all sorts of things, reshoring. Now people are even talking about the war happening in places like the Middle East and Russia and Ukraine, causing the demand for copper, all sorts of things now being a tailwind for commodities overall. And to me, this is just just adding to the case of why we think why we made this shift towards investing in hard assets here at Crescat, and why we think that because of the duration of the metals and mining industry, it makes us even more relevant as a place to be, focusing more in terms of capital and attention, and the level of inefficiencies that we see. So let's go to the next chart. And so the next chart now, we're looking at what I thought was interesting, just looking at hard assets overall. When you price them in gold, so in this case, we're looking at oil prices in gold terms, you can see that we just haven't seen true inflation across those commodities because they actually have underperformed true inflation. And so you can see that there are times in history when oil adjusted for gold prices reach very historical overvalue levels, and we're far from that. We're actually in the undervalue portion of this chart, as you can see in the green line that I provided there. And so to me, we're yet to see this push of commodities also adding pressure on inflation and consumer prices when these commodities start to really outperform gold. And also, I think goes to show of how commodities overall are really cheap relative to true inflation. And to me, it doesn't make the case for being bearish in gold by any means. If anything, it just makes the case for why I believe other commodities are so cheap. And while I'm using oil in this case, in this chart, you can also see the next chart, which shows agricultural commodities as well being in a downward trend, as you can see, for a long time. During that COVID recession, it sort of triggered actually a bull market that we had in agricultural commodities, all the way up to the peak of when the Russian invasion happened in Ukraine. And more recently, we've had gold prices surge, but actually agricultural commodities fall. And I know we made this point before, but today was a great example. Right after the numbers of PCE came out, and we started to see the numbers came out a little cooler than expected, then immediately we've had inflation cooling, but metals are surging. The irony of that is remarkable to me as well, because obviously metals are telling us a very different story than the media is telling us as well, and also a lot of government numbers too. But let's go to the next chart. You can see what fixes those problems is usually increasing supply of commodities. But the problem is we're just not seeing that. And the main reason for that, especially in the metal side, has to do with the fact that companies have just not spent enough. And usually there's a lag in this dynamic of producers' capex. They usually wait until metal prices reach more sustainable levels, sustainably higher levels, in order to start spending capital. And we just haven't seen today. Metal prices are certainly sustainably higher than they were back in other times in history. But the capex from producers is just so far away from where metal prices are today. And you can see that this chart is actually lagging the bread line by 2 years. And even with that, we're just so far away from that. And I think there are many reasons for that. Potentially the fact that we're seeing the access for capital being so difficult. But again, if you think about the duration of the metals and mining industry, because of how long it takes to go from discovery to a producing asset, and when I look at a chart like this, it just gives me even more conviction that this cycle for mining will probably take longer than prior cycles that we've had in the past, in which, to me, only reinforces this idea of deploying even more capital into companies that are smaller, that are more illiquid, but also offer potentially a higher upside, particularly at a time when people like to say that the best trades are the ones that you put it on when you're shaking. And I think I was telling Kevin a few weeks ago, is there anything that makes you shake the most than deploying the whole into an industry that nobody likes it, nobody really spends any time trying to understand? It's the most hated industry in the world. That's the type of shaking trade that I can get behind. And I can come up with many reasons, which I'm doing here in this case, of why I think in the future this industry is going to most likely receive attract some capital from all sorts of places in order to increase the supply of those metals. And as we see, the appreciation of shares of those companies over time as well, in my opinion, will probably be the case. So let's go to the next chart. And so you can see,
real quick comment, Tavi. If you don't want to be shaking and you want to be intrepid, just take a look at that CapEx chart, because that's how we sleep at night. The CapEx cycle is something that a lot of people just don't get. A lot of analysts don't even pay attention to. But you can look at that CapEx cycle for commodity metals, and you can look at it for IT, tech spending, and they're opposite cycles. So watch out. It's that same peak in the CapEx cycle that we had in 2000 at the peak of the tech bubble, that it looks like it's the same thing today with the AI boom to us. And the commodity cycle, however, CapEx cycle there is quite different.
So, yeah, that's right. That's right. The creation of 60/40 portfolios is what sucked capital out of commodities into all these other things, or even the weight of energy in the S&P 500. Or we should even talk about metals and mining. There's only one gold company in the S&P 500. Which I can't recall if it was actually removed from the S&P. It might actually be removed or not. If you guys remember, please feel free to say. But gold to silver ratio, I think, had an important development recently, and something that I don't think a lot of people have been paying close attention to, in which is today has been a different environment. But if you think about what happened so far this month, if I recall, silver is still up about double digits this month, and gold is up. I think it's actually single digits. Last time I checked, low single digits. I think it's 1 or 2% that gold is up this month. This is the last day of the month. That's why I checked those numbers, and I was surprised to see how much silver it was up, just because of the candle size of the monthly candle for silver is quite significant. And when we looked at the trend of the gold to silver ratio today, it's just broke a upward trend that we've had since 2011, when silver peaked in 2011 at $50 or so, and since then we've been now starting to break that trend, in which I believe it's just the beginning, and it's the main reason why I think silver is one of the most important and most undervalued metals in the world today. And if you think about this chart, just to give you a sense, for a 2,400 gold or so, if we look at the average of gold to silver ratio, and we put on, just a median ratio, so forth, and we try to apply that median ratio historically to a 2,400 price, we can easily get to a 45 to or above silver price today, which is such an important aspect. Is that I was speaking with someone this morning, asking me questions about what do I think silver could get to, and I'm not going to throw any price targets here, anything like that, but But I do think that if we believe that governments will essentially be suppressed from a cost of debt perspective at some point, at what can we see with gold prices in the future? I mean, who would have thought that Bitcoin would get to 30, 40, 50, $60,000, for a Bitcoin one day? Now, where can we get with gold prices when we see central banks actually go? Kevin had a chart there showing how central banks still have a very large exposure to fiat currencies. How does the math work when we actually see that massive decrease of exposure to fiat currencies and a large increase to gold, and we start seeing other parts of the world started to buy into this narrative that gold is a much better defensive asset than sovereign debt? I think that sort of self answers that question, but we can see an environment where gold can reach crazy levels in prices, in my opinion. And if that happens, what does that do to silver? I think it's just an important exercise to think about. And if you go to the next chart, the gold to silver ratio actually had its worst decline since the 2020s. And it's weird to say worse because when it means worse, it means it's actually great news, because it means silver is starting to lead. And to me, if people think that we're going to see a gold rush of central banks buying gold and accumulating the metal, and that won't lead to a silver rush, I think people just, those that believe in that probably just haven't studied history, because I think it's highly unlikely. I think what we're likely to see is that with gold is triggering a sense of demand for other metals that is just getting started. And I think silver will participate in a much bigger way than even gold, as we see the asymmetry to gold prices being much more attractive on the silver side and other commodities. But gold is an important aspect, is sort of the one that leads the way to the upside, and then other metals will lead even further as we get into those cycles being more endured. Let's go to the next chart. I'm almost done. Silver production, just looking at the Peruvian silver production, just because it's the second largest production in the world, along with China. It is at one of its lowest levels in history. It's a big decline. It's about 40% decline from its peak levels, as you can see in this chart. Look, I mean, it's just showing that the supply remains very constrained, the difficulty of finding new discoveries, and the difficulty of really creating and new projects that will become producing assets. And talk to any of the concentrate business, and you will hear the difficulty of finding high grade silver out there in the world. And so this is another reason why we like the metal in a significant way, and always been looking for ways to find leverage over even silver prices, because it seems like silver has such a leverage on gold itself. But if you can find leverage on silver itself without taking debt, but really buying high quality assets that have leverage to silver prices, I think that's one of the most elegant solutions to find exposure to the metal. Let's go to the next chart. I'm gonna go quick here. You can see mining stocks versus gold. What comes to mind in this chart is that it makes sense to see people so bearish in the mining industry when I look at this chart. First of all, it makes sense because people are just beat up trying to call the bottom and investing in this. But now that we're so close to a historical breakout, it's not the time, in my opinion, to be so bearish. I mean, that's just a backward-looking analysis. In fact, I would suspect that, imagine how many people are going to have to change their opinion. That's the best way to think about it. If this ratio begins to really outperform, meaning if mining stocks begin to really outperform gold, we're probably going to see a new wave of experts of mining, in which have in the last 3 to 5 years have really neglected investing in the space. And so, to me, that potential for a shift of narrative is one of the things that attracts me the most to this industry. And every time something goes up a lot, we tend to see all these new experts come along. And I'm yet to see. We're yet to see the mining experts that will come out of this cycle, in my opinion. And so, but the opportunity for that shift and the opportunity for the capital shift is, to me, one of the best ones that I've seen. And so I'm very focused on this because I'm starting to see mining stocks do better than gold in days that gold is not doing very well. And that to me is a step on the right direction. Let's go to the next chart. Final points and macro, which is not in the ladder, but on the macro side, by the way, the ladder is going to have also the reasons why we think that the mining industry has been lagging the gold and silver prices, and why we think the lag is your friend. And this is a term that Kevin used, and I'm just borrowing this term because I think it explains well. The smart capital they don't chase big, they chase big trends that are at their early stages, not the other way around. And when I showed charts of gold, silver, I remember showing, I just posted this chart of gold to silver ratio, and somebody came up to me, Tavi, why don't you wait for more confirmation before showing this? Because if I wait for more confirmation, then the trend already left the station. So I don't understand why people continue to do that, and it's just backward-looking analysis and the way to invest. And I'm not the media. Media will show you their views after the fact. Investors need to act before that, and that's I think that's what makes a successful investor. Nonetheless, this is a chart that I think is important. It's basically looking at estimated number of Fed cuts by December 2024, and if you recall, there were 7 rate cuts already priced in the markets back in January of this year. And today it's basically one. It's one of the highest levels, as you can see, which shows that it is one of the lowest amounts of cuts being priced in the curve. So we basically went from, we're going to see a full recession, we're going to see lots of Fed cuts, to now it's not as bad, and that speaks to me about complacency and also the risk of not only elections and all sorts of things that are happening in the treasury curve. With 10-year yields rising, to me, the higher they go, the higher the probability of a recession, the higher the probability of more Fed cuts. And so this, to me, is also starting to become very mispriced. And how to position towards this, I think is definitely the steepening of the yield curve idea. Is the fact that I think the long end of the curve will go higher, and ultimately the Fed and the government will actually force the Fed to also have to cut interest rates. I mean, remember, 3 interest rate cuts would reduce the interest payment chart that I had in the very first chart of this presentation by 1/3. And so think about that. And I think that regardless of who presidents will come in November or so, or they actually start next year, but elected in November, I believe that this is going to be an important aspect of how they will manage the finances of the government moving forward. Let's go next chart. I'm almost done, promise. This is just a list of the folks that today have their expectations for how many Fed cuts we're going to see. And to be quite honest, this same list 6 months ago was drastically different. So, anyways, let's go to the next chart. And this is the final one. It's just an interesting strategy that has been working since 2021 that I should point out. These folks that put out this analysis, really interesting stuff that basically shows every time an investor would sell the S&P 500 when oil goes above 90, and also basically buy back the S&P 500 when oil is below 90, they made a lot of money. And it's not my point. It's just to show that what it means is that we're in the stagflationary era, really. It's an era where when inflation expectations rise because oil prices or energy prices or commodity prices are rising, the market tends to struggle. This is what happens in the 70s. The correlations that we are seeing today are remarkably similar to the 1970s. And so, to me, this is the takeaway of this chart, not necessarily to replicate this strategy, but really to understand why this is happening. And to me, this has a lot to do with the inflation issues that we're seeing, and market participants is starting to price things in accordingly.